90 years ago, this coming October, more specifically between October the 24th and 29th, 1929, began that worldwide economic crisis known popularly as the Great Depression, or simply the Depression, which then caused various political extremist movements, especially fascist, national socialist and communist ones, to rise in many countries of the world. And some people actually see parallels now 90 years later with the rise of various patriotic, nationalist, anti-immigration or immigration critical and anti-globalization, anti-internationalist parties and movements, especially in Europe, but also elsewhere in the world. And I just wonder if there will be, this year in 2019 or later in the 2020s, various dictatorships springing up throughout the world. Hopefully that will not be the case. The so-called stock market crash in the New York Stock Exchange was certainly not the first one. There had been previous panics, in other words, panic selling of stocks in the late 19th century. Let's look at these Panic of 1873. It was a financial crisis that triggered a depression, an economic depression in Europe and North America that lasted, according to Wikipedia, from 1873 to 1879 and even longer in some countries. Interestingly, both of them considered major industrialized countries, Britain and France. This depression, however, is fairly rarely talked about, especially among the history students and practitioners, popular practitioners of history, and not so much maybe among the history teachers, maybe more those who teach history at the university, college, and seminary and graduate school level, and definitely those who write scholarly articles into historical periodicals. In Britain, for example, it started 2 decades of stagnation. I did, however, notice this term, the so-called Great Depression from 1873 to 1896, in a social history, a book of Britain, if I remember correctly, that weakened Britain's economic leadership. In the United States, it was known as the Great Depression, but however in quotation marks, until, of course, the events of the early 1930s set a new standard. And then there had been, I think, the Panic of 1893, if I remember correctly. In the 19th century, there had been many so-called panics or stock market crashes in 1819, 1825, 1837, 1847, 1857, then the first Black Friday, 1869, then this one which I mentioned, 1873, then the Paris Bourse or stock market or stock exchange crash of 1882, the Panic of 1884, Encillamiento, apparently happened in a Spanish-speaking country, the Panic of 1893, the Panic of 1896. And in the first decade of the 20th century, there had been 2 panics or stock market crashes, the ones of 1901 and 1907. Then just after the First World War had ended, there was a brief depression from 1920 to 1921. So this was by no means unique in that sense. There seemed to be at least one every decade since the 1810s in some of the major industrialized countries. However, it was this stock market crash whose ignoble 90th anniversary we will mark between October the 24th and 29th of this year, 2019, It was the United States history's most devastating stock market crash. When we consider how deeply and painfully affected not just the United States economy, but the economies of many other countries. The world already back then, 90 years ago, had a fairly globalized economic system, although we have to consider the fact that the transfer of money still wasn't even nearly as quick or easy as it is today when it can be done online. Even billions of whatever currency unit you have, dollar, euro, yen, ruble, and so forth, can be transferred in the twinkle of an eye, even from one continent to another. But still, the world had a fairly globalized economy, which meant that the economies of tens of countries were within a couple of years at the latest of this stock market crash in deep trouble. And one of the consequences of the Great Depression was that various countries had to take their currencies off the so-called gold standard, which had been linked to the British pound sterling. For example, Finland had to do this in 1931. And the Great Depression, according to Wikipedia, lasted for 12 years and affected all Western industrialized countries. The so-called Roaring Twenties, this relative prosperity, which did result in consumerism. For example, many cars were sold, especially in the United States, but also in many other countries. Many radios were sold, many other items that were considered luxuries became popularly available. However, as in many later decades, especially since the 1980s, many people lived beyond their means. In other words, they bought money on credit, and actually many of these so-called stock brokers or stock market investors also bought shares on credit with money that they actually didn't have. Which meant, of course, that once the stock market crashed, in other words, suddenly the prices tumbled by about 50%. Many of them lost money. And quite, a significant minority of them committed suicide, some even jumping from windows and crashing and dying on the streets below. While the US cities prospered, the overproduction of agricultural produce created widespread financial despair among American farmers throughout the 1920s. So this would later be blamed as one of the key factors that led to the 1929 stock market crash. Of course, there were other factors. Various countries that fought in the First World War, Germany being the prime example, suffered from hyperinflation shortly after the war because they had financed their war effort largely by printing money. In Germany, this led to the hyperinflation of 1923, when in the worst part of the financial crisis there, even such small items as a box of matches could cost millions of German marks. And finally, in 1924, through the so-called Dawes Plan, the German currency was stabilized, and it was called the so-called borrowed mark, or Rentenmark. And incidentally, in November 1923, a 34-year-old Austrian-German right-wing radical, Adolf Hitler, made his first coup attempt, the so-called Beer Hall Putsch, which then miserably collapsed, but which led to the writing, or actually dictation, of his political pamphlet or book known as Mein Kampf, or My Struggle. And then, although the United States by its gross domestic product prospered, still the gap between the rich and the poor remained huge. because then the United States did not have even the rather limited and partial form of the welfare state that it has had since the 1950s or 1960s, or in a more primitive form since the 1930s. Which meant that, for example, people who lost their jobs and were unable within some months of finding new ones were left basically, well, above all, to the mercy of God, but to put it in more secular terms, to the mercy of their loved ones, family members, relatives, then their friends, and then private charitable organizations, including churches. Because so few federal states in the United States, let alone the federal government or then the cities and rural towns, had public social welfare measures. Private charitable organizations did provide, for example, food aid and shelter and so forth. And indeed, the President of the United States at the time of the Great Depression's first years, Republican Herbert Hoover, who was a strong believer in private voluntary aid to the less fortunate, he strongly advocated sticking to the rugged individualism that would sooner or later bring the United States out of the Great Depression. He limited direct assistance during the Great Depression's early years, from 1929 to 1933, to the businesses, and believed, true to his individual-centered economic philosophy and business-centered economic philosophy, that eventually such relief measures would trickle down to the poor. He had much the same kind of economic philosophy as, guess who, Ronald Reagan, some 5 decades later. So despite the dangers of speculation, it was widely believed that the stock market would continue to rise forever. Some people have indeed, including some historians, have suggested that US President Calvin Coolidge, who was largely praised for this prosperity of the 1920s, wisely decided not to seek re-election to a second full term in 1928, something that he could easily have achieved because of the so-called Coolidge prosperity, despite the fact that he was one of the least working US presidents of the 20th century in terms of the measured working hours. He easily got tired, and he also was one of the most quiet US presidents, just about the total opposite of, for example, Lyndon Johnson and more lately Bill Clinton and Donald Trump. But he may have foreseen the eventual end of the US economic prosperity, and therefore have decided to just quietly retire into the private life in March 1929. Maybe it was some kind of coincidence, or he might even have predicted that his successor, Herbert Hoover, would not do so well, despite the fact that he had become so popular politician during his 7 years, 1921 to 1928, as U.S. Commerce Secretary during the Harding and Coolidge administrations, when Harding reportedly said about Hoover, without, of course, publicly criticizing him, "That man has given me much unsolicited advice during my presidency, 9/10 of it bad." He did, of course, not justify why he thought that the advice was bad. And ironically, during his 1928 successful presidential campaign, Mr. Hoover claimed that the United States was closer to a final triumph over poverty. We, of course, know what happened during the next 4 years. There were Hoover buggies, in other words, cars that had to be pulled by horses because their owners no longer could afford gasoline. Empty pockets turned inside out were called Hoover flags. And then, was it rabbits or some other animal slaughtered for food because many people couldn't afford to buy food in the stores, were called Hoover hogs. and then shanty towns created by these impoverished people were called Hoovervilles, and so forth. One of the relatively few stock market investors of the 1920s who foresaw the upcoming stock market crash was, guess who? Joseph or Joe Kennedy. He was a wealthy Democrat who then wisely sold just some months before the stock market crash of October 1929 his shares, and that's why he was able to, along with his other financial savvy features or savvy financial actions, he was able to afford to send his children to elite schools. And then eventually in 1938 he was appointed as the US ambassador to Britain. However, he was effectively dismissed in 1940 when he pessimistically expressed the opinion that democracy was finished in Britain and possibly or probably also in the United States. So March the 25th, 1929, just 7 months before the stock market crash, after the Federal Reserve, which is the US equivalent of a central or federal bank, warned of excessive speculation, a small crash occurred as investors started to sell stocks at a rapid pace, exposing the market's shaky foundation. On March the 27th, banker Charles E. Mitchell announced that his company, the National City Bank, would provide $25 million in credit, note of that time, much more in today's inflated dollars, to stop the market's slide. Mitchell's move brought a temporary halt to the financial crisis, and call money declined from 20 to 8%. However, the US economy showed ominous signs of trouble. Steel production declined, not that many new houses were constructed, fewer new cars were sold, and consumers were building up high debts because of easy credit. In other words, getting loans at ridiculously low interest rates and perhaps with little or no collateral. Despite all these economic trouble signs and the market breaks in March and May 1929, stocks resumed their advance in June, and the gains continued until almost without a break until early September 1929. The Dow Jones average gained more than 20% between June and September in the New York Stock Exchange. The market had been on a 9-year run that saw the Dow Jones Industrial Average increase in value tenfold, peaking at 381.17 on September the 3rd, 1929. Shortly before the crash, economist Irving Fisher, one of the many experts who were just flabbergasted, shocked, devastated by the seemingly sudden onset of the Great Depression, famously proclaimed stock market prices have reached what looks like a permanently high plateau. On September the 20th, the London Stock Exchange in Britain crashed when top British investor Clarence Hatry and many of his associates were jailed for fraud and forgery. This crash greatly weakened the US investment market's optimism in markets overseas. In the days that led up to the crash, the market was severely unstable. So there were periods when many stockbrokers and investors sold their stocks, and then there were brief periods of rising prices and recovery. In mid-October, more stocks were sold, and then on October the 24th, 1929, the so-called Black Thursday, the market lost 11% or 1/9 of its value at the opening bell on very heavy trading. Several leading Wall Street bankers met to find a solution to the panic and chaos on the trading floor, such as Thomas W. Lamont, acting head of Morgan Bank, Albert Wiggin, head of the Chase National Bank, and Charles E. Mitchell, president of the National City Bank of New York. They chose Vice President of the New York Stock Exchange, Richard Whitney, to act on their behalf. With the banker's financial resources behind him, Whitney placed a bid to purchase a large block of shares in US Steel at a price well above the current market. The Dow Jones Industrial Average did temporarily recover, closing with it down only 6.38 points for the day. On October the 25th, the rally continued, and even during the half session of Saturday the 26th, but unlike the situation in 1907, the respite was only temporary. Over the weekend, the events were covered by the newspapers across the United States. On October the 28th, Black Monday, more investors facing margin calls decided to get out of the market, and the slide continued with a record loss in the Dow for the day of 38.33 points, or 13%. In other words, it lost 1/8 of its value in a single day. On the next day, Black Thursday, October the 29th, 1929, about 16 million shares were traded as the panic selling reached its peak. Some stocks actually had no buyers at any price that day, so-called air pockets. The Dow lost an additional 30 points, or 12%, so another 1/8. The volume of stocks traded on October the 29th, 1929 would not be broken for almost 40 years. Also on October the 29th, William C. Durant, or Durand, joined with members of the Rockefeller family and other financial giants to buy large quantities of stocks to demonstrate to the public that they were confident in the stock market. However, their efforts failed to stop the large decline in prices. The market had lost over $30 billion of that time in the space of 2 days, including $14 billion on October the 29th alone. After a one-day recovery on October the 30th, where the Dow did manage to regain 28.4 points, or 12%, the market continued to fall, arriving at an interim bottom on November the 13th, 1929, so some 2 weeks after the Black Tuesday, with the Dow closing at 198.60 points. Then the market recovered for several months, starting on November the 14th, to then reach a secondary closing peak, or bear market rally, of 294.07 on April the 17th, 1930. So about 6 months after the start of this panic selling. From April 1931 to July the 8th, 1932, the Dow embarked on a much longer and steady slide. On that last mentioned date, it closed at 41.22 points, its slowest level of the 20th century, concluding an 89% loss rate for all of the market's stocks. And for the rest of the 1930s, starting on March the 15th, 1933, which was just 11 days after Franklin Roosevelt had taken office as the new US president, promising a New Deal, promising to fight the Great Depression, if necessary, with emergency powers, and proclaiming that he did not believe that the United States was finished as a democracy or as a capitalist country, but that the United States would be able to respond with leadership and vigor to the crisis, and that better days were ahead. And he, in fact, started his 12-year presidency by proclaiming a banking holiday, during which federally authorized or federal auditors went through the books of the financially troubled banks, and then decided which banks should be given federal monetary assistance to continue and which banks should be closed down. The Dow began to slowly regain the ground, so in March 1933, that it had lost during the 1929 crash and the 3 years following it. In late 1937, there was a sharp dip in the stock market, but prices held well above the 1932 lows. The market would not return to the peak closing of September the 3rd, 1929, until 25 years later, or November the 23rd, 1954, when the Republican US President Dwight Eisenhower was in his first term. So the crash followed a speculative boom that had taken hold in the late 1920s, and during that time steel production, building construction, retail turnover or profits, the registered new cars, and even railway receipts advanced from record to record. The combined net profits of 536 manufacturing and trading companies showed an increase in the first 6 months of 1929 of 36.6%, so over 1/3, over 1928, itself a record half year. Iron and steel led the way with doubled gains. A significant number of hundreds of thousands of Americans who invested heavily in the stock market, and they were encouraged by these superficially record-setting heights of the economic growth. I'm just reminded of what happened then in the 1980s that led to that worldwide economic recession of much of the 1990s, especially of its first half, and then the boastful and at least partly untruthful claims of the current US President Donald Trump that supposedly the US economy has never been as strong as it is now. And this, of course, is not true, because the US public and private debt has never been as high as it is now. And the gross national or federal debt of the United States has already for some years been bigger than its gross domestic product, which means that its prosperity is at least partly debt financed. And the United States is not the only country whose gross public debt is bigger than its gross domestic product. For example, Greece is in that situation. Interestingly, Japan and Italy at least has been in that situation. Belgium at least has been, and probably Portugal and Spain at least have been in that situation. Interestingly enough, none of the three countries where I have lived, Canada, Finland, Canada, or the Philippines, are in that situation. So they have overall managed their finances better than the aforementioned countries, including the United States. A significant number of these Americans who invested heavily in the stock market were borrowing money to buy more stocks. And by August 1929, brokers were routinely lending small investors more than 2/3 of the face value of the stocks they were buying. Over $8.5 billion of that time was out on loan, more than the entire amount of currency circulating in the US at the time. The rising share prices encouraged more people to invest, hoping the share prices would rise further. Speculation thus fueled further rises and created an economic bubble. Because of margin buying, investors stood to lose large sums of money if the market turned down. Or even failed to advance quickly enough. The average price-to-earnings ratio of Standard & Poor's composite stocks was 32.6 in September 1929, clearly above historical norms. Good harvests had built up a mass of 250 million bushels of wheat to be carried over when 1929 opened. By May, there was also a winter wheat crop of 560 million bushels ready for harvest in the Mississippi Valley. This oversupply caused a drop in wheat prices so heavy that the net incomes of the farming population from wheat were threatened with extinction. In August, the wheat price fell when France and Italy were bragging of a magnificent harvest, and the situation in Australia improved. Other important economic barometers were also slowing or even falling by mid-1929, including car sales, house sales, and steel production. In 1932, the Pecora Commission was established by the US Senate to study the crash's causes. In 1933, the US Congress passed the Glass-Steagall Act, mandating a separation between commercial banks. which take deposits and extend loans, and investment banks, which underwrite, issue, and distribute stocks, bonds, and other securities. After the 1929 crash's experience, stock markets around the world instituted measures to suspend trading in the event of rapid declines, claiming that the measures would prevent such panicked sales. However, they haven't totally succeeded, because on Black Monday, October the 19th, 1987, so during the so-called Reagan prosperity years, during his second presidential term, in fact, when the Dow Jones Industrial Average fell by 22.6%, in other words, by over 1/5, was worse in percentage terms than any single day of the 1929 crash. Although the combined 25% decline of October the 28th to 29th, 1929 was larger than this October 1987 crash, and remains the worst two-day decline forever. What finally ended the Great Depression in the United States was the World War II mobilization that began with the Lend-Lease Act in early 1941, and then just skyrocketed after the Japanese attack on the US naval base of Pearl Harbor in Hawaii in early December 1941. Sorry. To quote then US President Franklin Roosevelt, the United States had become the arsenal of democracy, in other words, the weapons warehouse of democracy. Because even during the best years of economic recovery, after the New Deal programs were instituted starting in 1933, which employed millions of Americans, whether on a short-term or fixed-term or long-term basis, even after all that recovery, all that investment of federal money directly to the unemployed, impoverished, and so forth, the US unemployment rate remained stubbornly above 10% even in the late 1930s. And indeed, there was an economic downturn in 1937, and it probably had already started in some way in 1936, prompting President Roosevelt to declare in his second inaugural address in January 1937. Let's find the precise quote. It's from www.bartleby.com. It comes from that short story Bartleby the Scrivener, by the way. Written by the American writer Herman Melville. Incidentally, during one of my university English courses, I think it was the course on American literature at Helsinki University in Finland in the academic year of 1996 to 97, I studied it. So anyway, I tried to find the quote. So while Franklin Roosevelt sounded optimistic, in fact, in these last 4 years, we have made the exercise of all power more democratic, for we have begun to bring private autocratic powers into their proper subordination to the public's government. Our progress out of the Depression is obvious. And he said, I see a great nation upon a great continent blessed with a great wealth of natural resources. I see a United States which can demonstrate that under democratic forms of government, and we have to remember that this was important because in 1937 most European countries were dictatorships, most Latin American countries were more or less dictatorships, most of those African countries that were independent were more or less dictatorships, and then the rest were ruled by colonial administrators. And even while the colonial powers themselves at home were democracies like France and Britain, the political systems instituted in those African colonies were usually less than democratic. And that was the case also in Asia, and most of the Asian countries that were independent were also more or less dictatorships. For example, Japan. Australia and New Zealand were democracies, solid democracies, although especially Australia was discriminating against its Aboriginal minority. But here is the challenge to our democracy. In this nation, I see tens of millions of its citizens, a substantial part of its whole population, because at the time, according to Roosevelt, there were about 130 million people in the United States. Now there are over 320 million, who at this very moment are denied the greater part of what the very lowest standards of today call the necessities of life. I see 1/3 of a nation ill-housed, ill-clad, ill-nourished. It is not in despair that I paint you that picture. I paint it for you in hope, because the nation, seeing and understanding the injustice in it, proposes to paint it out. Government-financed capital spending accounted for only 5% of the annual U.S. investment in industrial capital in 1940. By 1943, the government accounted for 67% of U.S. capital investment. And then for decades afterward, indeed we could say until Ronald Reagan became U.S. president in 1981, more or less all U.S. presidents, at least to some extent, favored the philosophy according to which the U.S. federal government had a right, or most of them favored the philosophy that, or at least tolerated the philosophy that the U.S. federal government had a right to step in by stimulating the economy when it was slowing down or even declining. And then, of course, during more prosperous times, it had to somehow restrain, for example, borrowing. But when Reagan came in 1981, this Keynesian philosophy was largely abandoned, although ironically, most of the deficits that he ran during his 8 years, although of course he blamed, for example, the vested interests, the liberal media, and the Congress, which for most of those years was Democratic dominated. I mean, for all of those years in the U.S. House of Representatives, I mean, nominally or officially, and then for 6 of the 8 years, the Republicans did have a narrow Senate majority. But anyway, he was unable to balance those budgets. For 3 of the 8 years, the budget had a deficit of over $200 billion at that time. And since then, the U.S. federal government has, in most years, run heavy deficits. The worst years were during the Obama presidency, when, and for some years of the second Bush presidency, when the budget had a deficit of over $1 trillion. And even during the 2017 to 18 fiscal year that ended on September the 30th, 2018, the U.S. federal budget had a deficit of over $900 billion. And when we add the interest payments on the horrendous debt, we can say that practically the U.S. was in the red federally by at least $1 trillion even during the previous fiscal year. The failure set off a worldwide run on US gold deposits, the dollar, and forced the Federal Reserve to raise interest rates into the slump. Some 4,000 banks and other lenders ultimately failed. Also, the optic rule, which allowed short selling only when the last tick in a stock's price was positive, was implemented after the 1929 market crash to prevent short sellers from driving the price of a stock down in a bear raid. The Great Depression soon spread into Europe because the world's economies were already so interconnected and led to massive unemployment, the failures of many banks and businesses, and the rise of many extremist political parties and movements. And seemingly, superficially it seemed, that various dictatorships, such as especially three, Benito Mussolini's Italy, which had become a fascist dictatorship already in 1922 and then fully by early 1925 with a fascist takeover of government and parliament. Then Joseph Stalin's Soviet Union. Joseph Stalin had become the Soviet dictator back in 1924 after Vladimir Lenin's death. And then his so-called 5-year economic plans, the first one of which had started, I think, in 1928. So, in other words, centralized planning for the production and economic growth for 5 years ahead. And of course, Adolf Hitler's Nazi Germany. He had become first the Reich Chancellor or Prime Minister in January 1933, and then by the end of July 1933 had virtually eliminated all significant opposition through the Night of the Long Knives, the so-called Gleichhaltung or consolidation, the abolition of other political parties, the abolition of the federal states, and already in April 19 or May 19 or March 1933, March or April 1933, through the so-called Enabling Act, which gave his government the power to legislate without the Reichstag or federal parliament's lower house for the next 4 years, but he of course then extended his dictatorship to 12 years. So seemingly through, for example, massive public works projects, the establishment of corporations, especially in Italy, the official employment of even political prisoners, and then the requirement that married women, if they had children, had to return home and become home workers, even if they were highly educated. Then superficially the unemployment rate was eliminated or at least radically reduced. But for example, the average salaries of workers in those countries were certainly not high. But the image was that they were more effective in fighting the Great Depression than were most democracies. And such democratic leaders as Franklin Roosevelt in the United States, Prime Minister Mackenzie King in Canada, then Prime Ministers Ramsay MacDonald, Stanley Baldwin, and Neville Chamberlain in Britain, then Léon Blum and Édouard Daladier in France, then in the Nordic countries, for example, Thorvald Stauning in Denmark, and then Prime Minister Nygaardsvold in Norway, Prime Minister Per Albin Hansson in Sweden, and in Finland, Presidents Per Evin Svinhufvud and Kyösti Kallio, and Prime Ministers Toivo Kivimäki and Aimo Kajander, and so forth, tried to show that even democracies could effectively fight against the Great Depression. The Nordic countries through, for example, the cooperatives and partly through emergency jobs and public works projects were able quite effectively to fight against the Great Depression. But still, for example, in Britain there was the so-called means test. In other words, they only wanted to give unemployment payments to those individuals and families who were so destitute that they really needed such payments. So there's ongoing debate among economists and historians as to what role the crash played in subsequent economic, social, and political events. Certainly it did encourage various extremist movements and parties and dictators. But of course, some people would have turned to such parties and dictators anyway, because even in the 1920s, certain European countries had turned from democracy to dictatorship, such as Lithuania under Antanas Smetona, Poland under Józef Piłsudski, then Bulgaria had become an authoritarian country since the overthrow and assassination of its tough-talking and anti-urban agrarian prime minister Alexander Stambuliski. Yugoslavia had become a royal dictatorship with Alexander I abolishing the democratic constitution in 1929. Spain had an authoritarian dictatorship under General Primo de Rivera. Well, Italy had become a dictatorship in the years 1922 to 1925. The Austrian democracy was on shaky ground because of the ongoing conflict between the right-wing Christian Social Party and the left-wing Social Democrats. And there had been this burning of the Palace of Justice in Vienna, Austria's capital, in July 1927. So some kind of march toward the dictatorships would have happened, for example, in Europe in the 1930s, even without a Great Depression. And we have to remember that in Latin America, most republics were not democracies to begin with. They were basically oligarchies. So some academics view the Wall Street crash of 1929 as a part of a historical process that was a part of the new theories of boom and bust. According to economists such as Joseph Schumpeter, Nikolai Kondratiev, and Charles E. Mitchell, the crash was merely a historical event in the continuing process known as economic cycles. The impact of the crash was merely to increase the speed at which the cycle proceeded to its next level. Milton Friedman's A Monetary History of the United States, co-written with Anna Schwartz, advances the argument that what made the Great Contraction so severe was not the downturn in the business cycle, protectionism, or the 1929 stock market crash in themselves, but the collapse of the banking system during 3 waves of panics over the 1930 to 1933 period.